Oops. Don't want that on the screen. Okay, what's the news? What's the headline here today? Do we have a headline? That's weird. Usually this works pretty good for real-time news. Wow, look at that USC. This is what I was worried about. Are we live now? This is so what I was worried about happening. You see these, you see the way the US dollar is just going nuts here? So well, like Jesus, look at this. Holy freaking hell. Gold. Ah, glad I took that position off. Holy. ES down 11 points, 280 point drop on the stocks. Woo, look at that gold go. See you later. Scoot-a-doo. Babies, baby. All right, there's your medium term view. So yeah, here comes the US dollar coming screaming back now. Look at the bonds just getting smoked here. Now our short term view. So there's the medium term view and there's the short term view. So US dollar is not really doing a hell of a lot here, even though on a short term it looks pretty dramatic. Let's see, where is that page? I want to see what they are showing on US Tubus. Where is US Tubus? Which page is that? Where'd it go? I didn't load it here, did I? Okay, under the heading of officially weird. I totally lost the page. Second from the right over here. Hey, there you are. 32 people watching. I hope all you 32 people are getting your money's worth. All right, live 2:30 p.m. Eastern time. They will be speaking. That's in about 27 minutes. Oh God, and now look at this bullshit. Now they're just gonna spoon feed you a whole bunch of. This is why the Federal Reserve is so great. We love him. What a load of horse shit. Oh, the politics of this world, eh? Oh, classroom ready online resources. Is that the meeting where the Rothschilds are attending? What a load of horse hockey. Hey, Rares! Hey, Rares. We gotta figure out what the hell to do with you. Anyway, look at all those hugs and kisses. You're awesome. Love you, babe. They're basically doing like a commercial here as to why the Fed's so awesome. I gotta mute that shit. I don't want to listen to that nonsense. Anyway, I got the interactive brokers account up and running here. So watching everything from this perspective, I was expecting to actually see some better news out of these guys, but I don't see anything going on. A little disappointing. We've got the hangout. Hey, there's a bunch of people in here too. Potter's here. Adam's here. Hey, Adam, Zug. Adam would like to know when we are officially being pushed out of airplanes, as he would like to join us. So I don't know, since we're live on YouTube, you probably don't want to talk right now. But Can you just maybe even just type in there? A hello to Adam. Adam on the and there he is over on the YouTube page. But on the Discord thing, Adam is what the hell is he? He is 12_cheese. Anyway, he reached out to me the other day and asked when he should be in Chicago. All right, we got about 40 people here. If you have any questions, oh, there you go. The Matador interested in Chicago Mile High Club as well. Not gonna be doing any hanky panky. I keep my pants on when I'm up top there. There will be no Mile High Club kind of check.
Yeah, all of us instructors were cute, but we're all dudes. So unless you're willing to change it up a bit.
No. He goes, yeah, we'll see. No, I'm sorry, pal.
If you close your eyes and use your imagination, it's almost as good.
All right. Anyway, the point of the matter here is Matador, if you're welcome. It sounds like we're all going to jump out of airplane together. So what the hell? We got to figure out, somebody's got to figure out how we can get a banner or something and made up for TRI. Because that
so what we might be able to plan is we could take a bunch of guys on tandems, and we could also have some of the people that work here, they can jump alongside us. And if there is a banner that can withstand 130-mile-an-hour winds, they can hold it, and they can like hold it in free fall, and we can probably get some pretty cool pictures and video. I know there are banners that people make that work for that kind of stuff. If someone wants to jump with their country flag or something like that. So yeah, it's totally doable. I'll think on it a little bit.
Yeah. And actually, I wouldn't mind just jumping on my own. I don't know whether I really want like a tandem one. Do they allow noobs to jump on their own?
So the way that works is you have to go through a whole training, which requires, I would say, if you're going to jump once on your own, then you should be under the assumption that you're going to be jumping a lot more, and you're going to go through the training to get your first license. But for just a one-off jump, no, they don't do it that way.
Yeah. All right. Well, I was
it would basically be
what's that?
I mean, if you want to become a skydiver, by all means, you can come, you can do the class here. We've got AFF instructors who will teach you and bring you through the process. And then, it's basically a 6-hour ground school. And then your first jump is like an hour or two of briefing and learning about some stuff. And then 2 instructors will jump out with you. But I don't know, they might also do it here where you need to go on a tandem first. It's not like that everywhere, but here they might do it that way. I kind of forget how they do it.
All right, well, taken under advisement. Thank you, sir. We'll figure out a plan. But regardless, I think we're jumping out of airplanes over the hopefully the sunny skies of Chicago, Illinois, which actually would be kind of cool because we should drag up Eddie and the Hogue. Any of you guys go over? Chris, you know the Hogue. Wouldn't that be hilarious to bring Hogue up with us? Anyway, mind you, God, it's been 10 years since I've worked with those guys. 10 years. Yeah, they probably don't even remember me anymore. Anyway. All right, what time is it? It is 10 minutes past the hour. Still got 20 minutes to go. I mean, we can look at a couple names if you are interested. I've told everybody that I don't really trust this market, and considering the options expiry that's coming up on Friday, I have a funny feeling that's what they're driving this market into, and today's going to be kind of a fluffy day. So just be forewarned. Having said that, the old rule, and if you don't know this, you might as well write it down. Don't trust the market until 1 full hour following the Fed announcement. I think they already came out with the news, so I don't think they raised rates. I think they kept everything the same, didn't they, Chris? Is that what you said? Probably should see it on all these major rags. Let's see, where the hell would I have this? I don't know which page it. So many pages. Probably here, probably has it. There's Josh out surfing. The White House. Oh God, they're gonna be touting the fact that they have gotten in front of this whole inflation issue. Hey, there's an image for you. Mr. Mo. And Fed said to pause rate hikes in June. I don't know whether have they actually come out with news yet? All right, what do we got here? Today is Wednesday. Yeah, oh, actually, we had inventory numbers. God, I wasn't even paying attention. There you go. So 5.25, so unchanged. And now we have to look at all this crap. Holy moly. Interest rate projection first year, second year, current 5.6, longer 2.5. I wonder what the hell that's about. I guess that's their dot plot crap that they're publishing nowadays. All right, so there's your headline right there. And we're probably on this thing, probably it says Fed has no change. Fed holds rates steady, but expects more hikes. So that's probably what's the market's going to be a little bit upset about. All right, we will tweet that out, I suppose. Oh, and I suppose we're supposed to, let's go see what the price action is. So is this sort of a buy the rumor, sell the news, sell the rumor, buy the news? It almost looks to me like US dollar index. See, I was worried about this. In years gone by, I'd get all excited about shorting this M top and saying, hey, this is a sell, this is a sell. Then the actual damn Fed announcement day comes out and the goddamn thing just ratchets straight up. Chung, 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 chung. So anyway, now we've got a big inverted wick, a sideways hammer. I think that's what social media is calling this. It's really called a tail, wick, by the way. What's that?
I was just laughing at your terminology there.
I mean, it's so funny with the crypto kids. Them sort of making up definitions as they go. Interesting how the euro dollar market's firming up here, though. So that's probably the most important market to watch if you're trying to figure out whether the Fed's actually done raising interest rates.
You think the euro could disappear?
Who?
The euro.
Euro. Let's see. What's the euro doing?
Like in 30 years from now, do you think there could be a chance that it's just gone?
30 years from now, do you think there's a chance that it's going to be gone? No, I don't think so. I think the euro's here to stay. If anything, what I would expect is that the US dollar, the Canadian dollar, and the Mexican peso are all going to merge into the Amero. And then the question ultimately is, does China actually survive through all of this? I think it's going to be awfully much more difficult to create like an Asian currency block. Because unfortunately the Asians, they have a bad habit of murdering each other quite violently. But yeah, no, I think the euro's here to stay.
I like China's technique. They start to just label the South China Sea, as theirs over the years, even though all the surrounding countries never really agreed upon said jurisdiction, and over time, it's just like becoming more and more of a thing that certain areas that weren't ever theirs are just theirs now.
Yeah,
feel
well,
like-
I mean, but that's the problem with, you wanna get into Asian politics. And you know, half of the reason why I like Toyota Motor Company so much right now is the Chinese have tried to corner the lithium market. And the Japanese are not gonna become the Chinese bitches for lithium. So. If anything, I don't see any of this changing. I think, you know, this was a very convenient situation for the Americans. Are we close to that thing starting yet? No, not yet. It was a very convenient situation for the Americans following the dot-com boom. They needed some sort of way to try and keep the inflation under in check while they went through their fear cycle. And now we're back into the greed cycle, and the interest rate picture, of course, has now turned. Jupiter, Saturn cross, all that bullshit. So now there really is no need for that Chinese deflationary sort of proxy in the marketplace anymore. So I don't think the Americans are going to kowtow to the Chinese anymore. So it'd just be really interesting to see whether the China that you see today, whether it even survives. I'm hearing that there's like Turkmenistan and Kazakhstan and all those kind of countries. They're all trying to get together and create sort of like a Mid-East trading bloc. So that's going to cannibalize the shit out of Western China. I wouldn't be surprised if China actually has to go back into sort of that regional civil war kind of stuff. Anyway, we'll see what happens.
Yeah, I mean, pre-COVID, all those riots were like front and center in the news, so I wouldn't be surprised if a lot of that comes right back.
Stanistan. I like the sound of that. Stanistan. Yeah, actually, I even saw a really interesting article. One of the most repressive nations in the world, but it's like the place is absolutely spotless. And of course, they're sitting on just a ridiculous amount of energy. So they've got all the money in the world. But like, I think it's like Turkmenistan or something like that. It's even more repressive than North Korea. And nobody ever talks about those kind of places. Interesting to see how Bitcoin just went and M'd out here. Be careful, all you crypto kids. Of course, you know, you don't want to hear this, but really nothing's changed with this short setup, folks. It's just working away, doing its thing. So, you know, actually interesting from a weekly chart perspective. There's not much holding this up here. You could wake up any day here and see this thing down like a good couple grand on the day, no problem. And then, of course, with regard to shalt coins, this actually is pretty close to a profit objective. I'm a bit surprised it never was hit. But I guess you could make an argument the other day that this 993.95, did that get hit? 992. Oh, it did. Son of a bitch. All right, so the 2-to-1ers, they're out. They've actually already taken profits. But lower highs and lower lows, there's no buy signal here anywhere in sight. Probably take that off. Anyway, so and it's kind of funny. There was some, you know, right at the top of the market, all the public comes out. They're all obviously experts at trading now. And there was some sea captain guy. Hey, I drive a big ship out in the ocean. I know technical analysis backwards. And he said that this thing was going to go to $7 trillion by the middle of July. Oops. You know, it probably would have been better if he said it's going to go to $700 billion by the middle of July. That probably would have been a more accurate prediction.
There's still time.
Well, and then you go out and you're like quiz him. All right, Mr. Technical Analyst, I went and mortgaged my future. I sold my kids into slavery on the understanding that I could buy them back when this thing hit 7 trillion, because that's what you said was going to happen. And he says, oh, well, actually, and it's so classic. It always happens with the Elliott wave people. Oh, my wave count was wrong. It turns out that it's not going to happen until the fall. Oh, give me a fucking break. It just makes you laugh. Anyway. All right, how close are we on Chair Powell now? 10 minutes till Chair Powell. And actually, this should be a really interesting tell. See how many people in the audience call him Chair Powell. And how many of the females in the audience call him Chair Powell? Because I have a feeling that's sort of like, if the media and the public are in love with Jerome Powell, then they call him Chair Powell. If they don't like him so much, they call him Mr. Powell or Mr. Chairman or something very formal like that. So just keep your eyes peeled. That's a really interesting little tell. So keep your eyes peeled for who says Chair Powell. And 9 times out of 10, the girls say Chair Powell, and you can tell if they say it with like a glint in their eyes that they want his baby. All right, so you can see the knee-jerk reaction was a move back into the US dollar, probably a bunch of short covering there. Remember, we showed you that gold market just absolutely puked out there. So there were probably a bunch of people that bought this, and then, because if you look at this on like a 4-hour chart, where is that? Yeah, right here. In fact, if anything, this looks like it was just a trade location right there. I mean, this is basically what I teach at the site. For the day traders, I love hunting against horizontal support and resistance. The only issue is I would drill down to like the 3-minute chart here, and I'd start hunting for divergence, but my hunch is that because this happened so quickly, there just isn't any sign of it yet. So that was that dump into these levels. And then let's see, do we have any divs? No, there's nothing at all here yet. So that makes sense. I mean, who's going to put on a position right ahead of what Jerry's about to say here? It's kind of asking for trouble. Now this is I had said earlier, this is the interesting one that you want to keep an eye on. Notice how the euro dollar market actually is trying to W out here. And the Fed funds market, the Fed funds, they were actually pricing in higher rates there. So now they're taking that back. On a longer term basis, of course, our sine wave, we expect that the money cycle should turn somewhere here through this summer. So I guess we're right on course. But interesting how the euro dollar market, notice how they tried to bottom here, but the spread was just so wide. So that brought the spread back in. So here they go again. They're trying to bottom the market. So actually this should be a period where the inflationary data coming out of the States should be relatively benign. Anyway, we'll see what happens. Only time will tell. So this is sort of the medium term. Let's keep an eye on the bonds. Fascinating how that long bond actually just went and M'd out. And if anything, you might even argue that that's kind of what the market would like, because I don't think the market can rally in earnest as long as this looks like this. So that's a problem. If anything, you want to see the long bond top out in price and the yield start moving back up in earnest. So this flattens out. But I think the statement was that they're gonna still be raising rates in the future, that they're just going on pause here. And if anything, right, so what are they saying here? Fed reserve less, target rate, Fed fund unchanged, but signals rates may go to 5.6 by year end if the economy and inflation do not slow down more. It is the first pause in the tightening campaign following 10 consecutive hikes that lifted borrowing costs 500 beeps. Interesting, you got the Dow off good 400 points, so the knee-jerk reactions to the downside. If anything, we've been talking a little bit about that, how it felt like there was some sort of blow off top that was happening in the market. And we always say you don't really want to interpret too much into this until you start seeing about 2 to 3% moves. So even a 400 point drop is only a 1.25% move. It's not even really an event in the market's eyes. And interesting how like NASDAQ, the high flying, tech yahoos, they're only down about 0.5% right now. So the question ultimately is this it for the blow off top? And like I said, Friday's the options expiry. So my hunch is I don't think so, but probably when Mr. Powell does start speaking, we'll probably see a lot of this start to come back. So does an M start to develop in the US dollar, W's in euro? Actually, where's the euro? Right here. Do the W's start coming in on these things? You can kind of already start to see it happening. So if the W's do start coming in, and that M will start coming in, and then you probably see stocks start to come back. You can see they're all pretty weak right now. But I've been sort of barking with the site people that the question ultimately is this some sort of big megaphone top here on the stock indexes? Yeah, there you go. So there's the megaphone. Boom, boom, there it is. So did we just go and fail at the top of the megaphone? And we've also, in the free broadcast recently, I've been talking to you guys about how rising wedges inherently are bearish. So that was a rising wedge heading into this event. It really shouldn't surprise us that the knee-jerk reactions to the downside. I suppose the issue that we have to ask right now is what's the uncle point for Wall Street? And how are we doing? Have they started talking yet? 3 minutes. So I like to follow the S&P 500, the big monthly options expiries coming up here. Quadruple witching, 90 to 95% of all puts are written by institutions. So where is their uncle point? Here they are, 334. It's interesting how there's a little bit of a notch here in the open interest profile. I think they probably want to take this thing out above 436. If they can do that, then that's like a pretty big home run. My hunch is probably into Friday, they even try and take it out above this 438 up here. So I don't think that this is it. Yeah, it looks pretty ugly. Bang. But I wouldn't even be surprised, but by the end of his speech, that you can kind of see the rising wedge, right? So it's there to there. What a surprise. We just banged in against the bottom of the wedge here. And I wouldn't be surprised if we do something like that into that options expiry. So the options expiry here is on the 16th, something like that. So be forewarned. I don't know whether I really want to get sucked too much into the bearish enthusiasm here. Now we're supposed to inject a commercial. Is this monetized? Chris, I don't know whether we did that or not. Suppose if you're going to inject a commercial, now's the time to do it before the Fed starts. We got one. What's that? Oh, okay. I don't know. I just like you said, it just popped up and I whoa, what the hell is that? Okay, so if anything, make the call. Interesting how we banged up against this 4-hour pivot low. So right into that area. I wouldn't be surprised if there is a bull div that develops off the lower time frame. That's probably a half decent little day trade to take. And then candle body highs for trade location. Notice how that also lines up with that trend line up there. And that's probably a reload zone. So let's see. Do we have the bull divs starting to form yet? Oh, there they are, starting to form. Maybe one more knee-jerk pump down here. So there we go. He's about to start speaking, so I'll try and refrain from talking. Maybe Chris, you can throw that up on the screen. And we'll see what happens. Okay, we all have to, let's, in fact, we should play a drinking game. I'm only drinking coffee. I don't want to actually go put some booze into this. Every time somebody says, "Chapa," you got to drink. Interesting. Look how the Eurodollars now have rolled over here. That's interesting. Here he comes. Here he comes. Ugh. I'm gonna have to put myself on mute while he's on because I want to hear what he has to say.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time. And I will have more to say about monetary policy after briefly reviewing economic developments. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. In our summary of economic projections, the median projection has real GDP growth at 1.0% this year and 1.1% next year, well below the median estimate of the longer run normal growth rate.
1%?
The labor market remains very tight. Over the past 3 months, payroll job gains averaged a robust 283,000 jobs per month. The unemployment rate moved up but remained low in May at 3.7%. There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has declined, labor demand still substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises to 4.1% at the end of this year and 4.5% at the end of next year. Inflation remains well above our longer-run 2% goal.
Somebody take a
Over
screenshot
the
of
12
that.
months ending in April, total PCE prices rose 4.4%. Excluding the volatile food and energy categories, core PCE prices rose 4.7%. In May, the 12-month change in the Consumer Price Index came in at 4%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.2% this year, 2.5% next year, and 2.1% in 2025. Core PCE inflation, which excludes volatile and food and energy prices, is projected to run higher than total inflation, and the median projection has been revised in the SEP up to 3.9% this year. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5 percentage points. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5 to 5.25%, and to continue the process of significantly reducing our securities holdings. As I noted earlier, nearly all committee participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at this meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In our SEP, participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 4.6% at the end of 2024, and 3.4% at the end of 2025. For the end of this year, the median projection is a 0.5 percentage point higher than in our March projections. I hasten to add, as always, that these projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do at the Fed is in service to our public mission. We will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Colby. Thank you. Colby Smith with the Financial Times. I'm curious what gives you and the committee the confidence that waiting will not be counterproductive at a time when the monthly pace of core inflation is still so elevated, interest rate sensitive sectors like housing, while they felt the drag of the past Fed actions, have started to recover in some regions, and financial conditions, most recently were easing.
So I guess I would go back to the beginning of this tightening cycle to address that. So as we started our rate hikes early last year, we said there were 3 issues that would need to be addressed kind of in sequence. And that of the speed of tightening, the level to which rates would need to go, and then the period of time over which we'd need to keep policy restrictive. So at the outset, going back 15 months, the key issue was how fast to move rates up, and we moved very quickly by historical standards. Then last December, after 4 consecutive 75 basis point hikes, we moderated to a pace of a 50 basis point hike, and then this year to 3 25 basis point hikes at sequential meetings. So it seemed to us to make obvious sense to moderate our rate hikes as we got closer to our destination. So the decision to consider not hiking at every meeting and ultimately to hold rates steady at this meeting, I would just say it's a continuation of that process. The main issue that we're focused on now is determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time. So the pace of the increases and the ultimate level of increases are separate variables. Given how far we have come, it may make sense for rates to move higher, but at a more moderate pace. I want to stress one more thing, and that is that the committee decision made today was only about this meeting. We didn't make any decision about going forward, including what would happen at the next meeting, including we did not decide or really discuss anything about going to an every other meeting kind of an approach or really any other approach. We really were focused on what to do at this meeting.
So there was no kind of initial debate about the possibility of July, any sense of the initial support at this stage for that move?
So again, we didn't make a decision about July. I mean, of course, it came up in the meeting from time to time, but really the focus was on what to do today. I would say about July 2 things. 1, decision hasn't been made. 2, I do expect that it will be a live meeting.
Thanks, Howard Schneider with Reuters. I was just wondering if you could help us understand the narrative here, because it feels like there's been a level shift.
Chair Powell, he
in the
doesn't want
dots.
his baby.
Stronger GDP, less of a hit to unemployment, slower progress on inflation. And I'm wondering, in this, sort of, where's the disinflation coming from?
Sure.
The labor market's going to be stronger, it looks like. It's not coming from there. Demand's not coming down all that fast, according to GDP. You've doubled your estimate of GDP. So what's the narrative here? It seems like it's getting more immaculate rather than more messy.
So you're right that the data came in, I would say, consistent with, but on the high side of expectations. So, and if you go back to the former SEP, the last SEP in March, you will see that growth moved up. These are not huge moves, but growth estimates moved up a bit. Unemployment estimates moved down a bit. Inflation estimates moved up a bit. And, all 3 of those kind of point in the same direction, which is, that perhaps more restraint will be necessary than we had thought at the last meeting. So, although the level, frankly, is pretty, the level of 5.6 is pretty consistent if you think about it, where the federal funds rate was trading before the bank incidents of early March. So we've kind of gone back to that. So your question is, where's the disinflation going to come from? And I don't think the story has really changed. The committee has consistently said and believed that the process of getting inflation down is going to be a gradual one. It's going to take some time. And I think you go back to the 3-part framework for core PCE inflation, which is, we think, as good an indicator as you can have for where inflation is going forward. You start with goods. With goods, we need to see continued healing in supply side conditions. They've definitely improved a substantial amount, but if you talk to people in business, they will say it's not back to where it was. So that's one thing, and that should enable goods prices to continue, goods inflation to continue to come down over time. In terms of housing services inflation, that's another big piece, and you are seeing there that new rents, new leases are coming in at low levels, and it's really a matter of time as that goes through the pipeline. In fact, I think any forecast that people are making right now about inflation coming down this year will contain a big dose of this year and next year, will contain a good amount of disinflation from that source. And that's, again, probably going to come slower than we would expect. That leaves, the big sector, which is a little more than half, pardon me, of core PCE inflation. That's non-housing services. And, we see only the earliest signs of disinflation there. It's a sector, it's a very broad and diverse sector. I would say in a number of the parts of that sector, the largest cost would be wage costs. It's the service sector, so it's heavily labor intensive. And I think many analysts would say that the key to getting inflation down there is to have a continuing loosening in labor market conditions, which we have seen. We have actually seen, I go through a number of indicators suggesting there's been some loosening in labor market conditions. We need to see that continue. I would almost say that the conditions that we need to see in place to get inflation down are coming into place, and that would be growth meaningfully below trend. It would be a labor market that's loosening. It would be goods pipelines getting healthier and healthier and that kind of thing. The things are in place that we need to see, but the process of that actually working on inflation is going to take some time.
Nick.
Nick Tamaros of the Wall Street Journal. Chair Powell, what's the value in pausing and
he does
signaling
want
future
it,
hikes
baby.
versus just hiking now? I mean, not to be flippant, but I don't lose weight just by buying a gym membership. I have to actually go to the gym. 16 of your colleagues put down a higher year-end 23 rate today. A majority of you think you're going to have to go up by 50 basis points this year. So why not just rip off the Band-Aid and raise rates today?
So first I would say that the question of speed is a separate question from the question from that of level. Okay, so and I think if you look at the SEP, that is our estimate, our individual. It's really accumulation of our individual estimates of how far to go. I mentioned how we got to those numbers. In terms of speed, it's what I said at the beginning, which is speed was very important last year. As we get closer and closer to the destination, and according to the SEP, we're not so far away from the destination in most people's accounting. It's reasonable, it's common sense to go a little slower, just as it was reasonable to go from 75 basis points to 50 to 25 at every meeting. And so the committee thought overall that it was appropriate to moderate the pace, if only slightly. And there are benefits to that. So that gives us more information to make decisions. We may try to make better decisions. I think it allows the economy a little more time to adapt as we make our decisions going forward, and we'll get to see. We don't know the full extent of the consequences of the banking turmoil that we've seen. It would be early to see those, but we don't know what the extent is. We'll have some more time to see that unfold. I mean, it's just the idea that we're trying to get this right, and this is if you think of the two things as separate variables, then I think that the skip, I shouldn't call it a skip, the decision makes sense.
I know you said July is live with only one June employment, with only the June employment and the CPI report for June due to be released before the July meeting. You get the ECI after, you get the senior loan officer survey after, you get some bank earnings at the end of next month. What incremental information will the committee be using to inform their judgment on whether this is in fact a skip or a longer pause?
Well, I think you're adding that to the data that we've seen since the last meeting too. Since we chose to maintain rates at this meeting, it'll really be a 3-month period of data that we can look at. And I think that's a full quarter, and I think you can draw more conclusions from that than you come from any 6-week period. We'll look at those things. We'll also look at the evolving risk picture. We'll look at what's happening in the financial sector. We'll look at all the data, the evolving outlook, and we'll make a decision.
Gina.
Thanks for taking our questions. Gina Smilek, New York Times. You obviously, in your forecast, marked up the sort of path for growth, marked down the path for unemployment, marked up the path for inflation pretty notably. I wonder, since March, what has changed to make you think that the economy is a lot more resilient and inflation is going to be a lot more stubborn? And given that, why do you feel confident that this is as high as you're going to have to revise the federal funds rate, or do you think it's possible we could have even a higher than 5.6% terminal by the end of this cycle?
You know, I mean, on the first part, I just think we're following the data and also the outlook. The economy is, the labor market, I think, has surprised many, if not all, analysts over the last couple of years with its extraordinary resilience, really.
I just heard that they're
And,
probably not going to raise in July.
It's just remarkable, and that's really, if you think about it, that's what's driving. It's job creation, it's wages moving up, it's supporting spending, which in turn is supporting hiring, and it's really the engine, it seems, that is driving the economy. So it's really the data. In terms of, you know, we always write down at these meetings what we think the appropriate terminal rate will be at the end of this year. That's how we do it. It's based on our own individual assessments of what the most likely path of the economy is. It can actually, in reality, wind up being lower or higher. And you know, there's really no way to know. But it's what people think as of today. And as the data come in, it can move around during the intermeeting period. It could wind up back in the same place. But it really will be data driven. I can't tell you that I ever have a lot of confidence that we can see where the federal funds rate will be that far in advance.
Mr. Chairman, thanks for taking my question. You had said back at the end of May
Mr.
that you
Chairman.
thought risks were getting closer to being into
Steve
balance.
Leisman does not
Is
want
that
his
still
baby.
the case, or has your mind changed about the balance of risks out there? And also, could you give us an idea of what would
Steve
be
would
a
not be
sufficiently
invited to the Mile High
restrictive funds
Club.
rate? Is obviously the current rate, according to the committee, is not sufficiently restrictive. Is it 5, 6? Is it 6 years or sufficiently restrictive? Thank you.
You know, I would say again that I think that over time, the balance of risks, as we've moved from from interest rates at effectively 0 now to 5 percentage points with an SEP calling for additional hikes, I think we've moved much closer to our destination, which is that sufficiently restrictive rate. And I think that means, almost by definition, that the risks of sort of overdoing it and underdoing it are getting closer to being in balance. I still think, and my colleagues agree, that the risks to inflation are to the upside still. So we don't think we're there with inflation yet, because we're just looking at the data. And if you look at the full range of inflation data, particularly the core data, you just aren't seeing a lot of progress over the last year. Headline, of course, inflation has come down materially, but as you know, we look at core as a better indicator of where inflation
All
overall
right,
is
so
going.
the market should now reverse
Sufficiently,
its rally
so I
there.
think, you know, what we'd like to see is credible evidence that inflation is topping out and then beginning to come down. That's what we want to see. Of course, that's what we want to see.
Notice
And,
Bitcoin just down.
I think it's also, we understand that there are lags, but remember that it's more than a year since financial conditions began
Oh,
tightening.
crypto's such a leading
I think
indicator.
the reason we're comfortable pausing is that we are still, much of the tightening took place over last summer and later into the year, and I think it's reasonable to think that some of that may come into effect. So we're, you know, I think stretching out into a more moderate pace is appropriate to allow you to make that judgment of sufficiency, you know, with more data over time.
Rachel.
Hi, Chair Powell. Rachel Siegel from the
Hello,
Washington Post.
Rachel.
Thanks for taking our
What's
questions. I wanted to ask further on the lag effects. When you're considering when you would hike again throughout the course of the year, are there things that you would expect to kick in as those lag effects come into effect that would inform your decisions? Have you learned things over the past year that give you some sense of timeline for when to expect those lags to come into effect?
Yeah. So it's a challenging thing in economics. It's sort of standard thinking that monetary policy affects economic activity with long and variable lags. Of course, these days, financial conditions begin to tighten well in advance of actual rate hikes. So if you look back when we were lifting off, we started talking about lifting off. By the time we had lifted off, the 2-year, which is a pretty good estimate of where policy is going, had gone from 20 basis points to 200 basis points. So in that sense, tightening happens much sooner than it used to in a world where news was in newspapers and not on the wire. So that's different, but it's still the case that what you see is interest-sensitive spending is affected very, very quickly. So housing and durable goods and things like that. But broader demand and spending and asset values and things like that, they just take longer. And you can pretty much find research to support whatever answer you would like on that. So there's not any certainty or agreement in the profession on how long it takes. So, and that makes it challenging, of course. So we're looking at the calendar, we're looking at what's happening in the economy, we're having to make these judgments. And again, it's one of the main reasons why it makes sense to go at a slightly more moderate pace now as we seek that ultimate. I can't point to that ultimate endpoint. I can't point to a specific data point. I think we'll see it when we see inflation, really flattening out reliably
need
and then
something
starting
in
to
the
soften.
economy to
I think
break.
we'll know that it's working.
And you can't
And
predict when
ideally,
that's gonna happen.
by taking a little more time, we won't go well past the level where we need to go.
I was curious if you could give us an update on what you're seeing on credit tightening since the bank incidents from March and how you're teasing that out apart from these lag effects.
So it's too early still to try to assess the full extent of what that might mean. And, that's something we're going to be watching, of course. And, if we were to see what we would view as significant tightening beyond what would normally be expected because of this channel, then, we would factor that into account in making rate decisions. So that's how we think about it.
Let's go to Chris.
Thanks. Chris Rugaber at Associated Press. You mentioned that many of the trends are in place that you want to see. Core services ex-housing has come in pretty low in the past couple of months. And as you noted, a significant portion of core inflation is now housing prices. And then we've had some quirks in used car prices. So given that these trends are in place, I guess I'm sort of asking the flip side of Nick's question, why signal additional rate hikes? Aren't things headed in the direction you need? Why not simply give it even more time? Or
You didn't even say
it's
his
surprising
name.
to see so much hawkishness in the dots, given what we're seeing recently.
Yeah, so, we've, remember, we're 2.5 years into this, or 2.25 years into this, and forecasters, including Fed forecasters, have consistently thought that inflation was about to turn down, and typically forecasted that it would, and been wrong. So I think if you look at core PCE inflation overall, look at it over the last 6 months, you're just not seeing a lot of progress. It's running, and it's running at a level
Core
over
PCE, that's what we gotta be
4.5%,
watching,
far above
folks.
our target, and not really, moving down. We want to see it moving down decisively. That's all. Of course, we are going to get inflation down to 2% over time. We don't want to do. We want to do that with the minimum damage we can to the economy, of course. But we have to get inflation down to 2%, and we will. And we just don't see that yet. So, hence you see today's policy decision, both to write down further rate hikes by the end of this year, but also to moderate somewhat the pace with which we're moving.
Mr.
Quick
Powell's
follow-up.
telling you he needs
The
to
last
see
press
this
conference, you mentioned you
economic
didn't see
break.
wages driving inflation, and there was some research from the San Francisco Fed suggesting wages aren't necessarily a key driver, but you've talked about the labor market today and the need for softening. Can you give us a little more specifically of how you see the tight labor market driving inflation at this point? Thank you.
Right, so I'm not going to comment on any particular paper, but I would say that I think the overall picture is that at the beginning, in early 2021, inflation was really coming from very strong demand largely for goods. People were still at home, they had money in the bank, and they wanted to spend, and they spent a lot on goods. And of course, at the same time, and because of that high demand to some extent, supply chains got all snarled up. So prices went way up, inflation went way up. So that was the origin, and it wasn't really particularly about the labor market or wages. But as you moved through 21 into 22 and now in 23, I think many analysts believe that it will be important, an important part of getting inflation down, especially in the non-housing services sector, to getting wage inflation back to a level that is sustainable, that is consistent with 2% inflation. We actually have seen wages broadly move down, but just at a quite gradual pace. So, and that's a little bit of the finding of the Bernanke paper with Blanchard of a few weeks ago, which is very consistent with what I would think.
go to Michael McKee.
Michael McKee from Bloomberg Radio and Television. You said in the past that you don't like to surprise markets. It's kind of been the Fed's view. Markets should have an idea of what you're going to do before you go in. You also said a number of times that it would take a while to bring inflation down. You reiterated that again today, and that we would get to a point where inflation could be sticky. So I'm wondering, as we go into the next meetings, how Wall Street or others should look at your reaction function. What will you be reacting to, time or data? In other words, if nothing much changes, if we're looking at the same sort of labor market, the same sort of inflation
Or
levels
PCE
in
year
July
over
or in
year is
September,
double bottoming. Do you like that
or
better,
November,
Chris?
will you move because you've said you feel you need to? Is it time that's going to require additional movement, or would it be a reversal in inflation?
That guy
So,
doesn't want his baby either.
I don't want to deal with hypotheticals about different ways data might move out. So we of course, we don't go out of our way to surprise markets or the public. At the same time, our main focus has to be on getting the policy right. And that's what we're doing here. And that's what we'll do for the upcoming meetings. I will say the July meeting will be live, and we'll just have to see. I think you'll see the data, you'll hear Fed people talking about it, and markets will have to make a judgment.
Well, do you think inflation is likely to continue coming down based on the lags and based on your threat of additional movement? Or are we going to be in a period where we're not going to know what's happening?
I think if you look at, if you just look at, I'll just point you to the forecast. So inflation is running, core PCE inflation is running at about 4.5%, a little higher than 4.5%, and the median FOMC participant thinks it'll go down to 3.9 on a 12-month basis. This is by the end of this year. So that's expecting pretty substantial progress. That's a pretty significant decline for half a year. So that's the forecast.
In other words, that ain't gonna happen, folks.
We do try to be transparent.
When was the
in our
last time
reaction
that any of
function.
these people were right?
We're committed to getting inflation down, and that's the number one thing. So that's how I think about it.
Let's go to Victoria.
Victoria Guido with Politico. Could you talk about the
He
balance
does
sheet
not
and how
want
you're
his
thinking
baby.
about it? What are you looking for to judge whether
I think we've had only one Chair Powell today,
is Treasury
right?
issuance going to affect that? Also, are you considering lowering the RRP rate in order to take some pressure off banks?
So let me say, first of all, on the Treasury part of it, if I can talk about that, and then go back to the balance sheet. So on that, of course, we've been very focused on that for a couple of months, as everyone has. Treasury has laid out its borrowing plans publicly. I think I saw the Secretary's comments yesterday to the effect that Treasury has consulted widely with market participants about how to avoid market disruption, and that they're going to watch carefully for that. So that's from the Treasury, which actually sets the borrowings. At the Fed, we'll be monitoring market conditions carefully as the Treasury refills the TGA. The adjustment process is very likely to involve both a reduction in the RRP facility and also in reserves. It's really hard to say at the beginning of this which will be greater. We are starting at a very high level of reserves and still elevated RRP to take up, for that matter. So we don't think reserves are likely to become scarce in the near term or even over the course of the year. So that's the Treasury part of the answer. We will, of course, continue to monitor conditions in money markets, and we're prepared to make adjustments to make sure that monetary policy transmission works. Was there another part of your question?
Yeah. What are you considering lowering the RRP rate to help take some pressure off banks?
So we have a number of, I would say, the RRP doesn't look like it's pulling money out of the banking system. It's actually been shrinking here lately. So I don't think that's not something we've thought about a lot over time. It doesn't really look like that's something that we would do. I think it's a tool that we have. If we want to use it, we can. There are other tools we can use to address money market issues, but I wouldn't say that that's something that's likely that we would do in the near term.
Janelle Marte with Bloomberg.
Have you seen sufficient cooling in the housing market to bring inflation down?
I
For
know
example,
we're
how
no
does the
Chair
recent
Powell.
rebound affect
I
your
know these guys
forecast?
actually hate him.
And how does it factor into monetary policy?
So certainly housing, very interest sensitive, and it's the first place really, or one of the first places that's either helped by low rates or that is held back by higher rates. And we certainly saw that over the course of the last year. We now see housing putting in a bottom and maybe even moving up a little bit. You know, we're watching that situation carefully. I do think we will see rents and house prices filtering into housing services inflation, and I don't see them coming up quickly. I do see them kind of wandering around at a relatively low level now, and that's appropriate.
Do you think you'll have to target that with further rate increases?
Well, I think we look at everything. We don't just look at housing. So I think, you know,
But
the
didn't
way
he
it
say
works
housing
is
was
individual
50%?
participants sit in their offices all over the country and they write down their forecast, and including their most likely forecast, including their rate forecast, and then they send it in on Friday afternoon, and we accumulate it, and then we publish it for you. So that's how they do that. Well, I don't know that housing is itself going to be driving the rates picture, but it's part of it.
Let's go to Edward.
Thank you for taking the question, Mr. Chairman. Edward Lawrence with Fox Business. So I want to
Mr.
go back to comments you
Chairman.
made about, in the past, about unsustainable fiscal path. The CBO projects the federal deficit to be $2.8 trillion in 10 years. The CBO also says that federal debt will be $52 trillion by 2033. At what point do you talk more firmly with lawmakers about fiscal responsibility? Because I'm assuming monetary policy cannot handle alone the inflation or keep that inflation in check with the higher level of spending.
I don't do that. That's really not my job. We hope and expect that other policymakers will respect our independence on monetary policy. And
What a load
we
of
don't
horse
see ourselves
shit.
as you know, the judges of appropriate fiscal policy. I will say, and many of my predecessors have said, that we are on an unsustainable fiscal path, and that needs to be addressed over time. But I think trying to get into that with lawmakers would be kind of inappropriate, given our independence and our need to stick to our knitting.
Is there any conversation then about the Federal Reserve financing some of that debt that we're seeing coming down the pike?
No, under no circumstances.
Courtney.
Thanks
What
for
a
taking
crock
our
of shit
questions,
right there,
Chair Powell.
folks.
So looking at the SEP, it looks like GDP for this year was raised significantly, your forecast for GDP this year. The unemployment rate, meanwhile, was pulled downward. And so should we take that as a sign that the committee is more confident about the prospects of a soft landing, at least as it relates to what you were expecting in March?
You know, I would just say it this way.
Look at this stock
I
market just
continue
is
to think,
taking
and this
off
really
here.
hasn't changed, that there is a path to getting inflation back down to 2% without having to see the kind of sharp downturn and large losses of employment that we've seen in so many past instances. It's possible. In a way, a strong labor market that gradually cools could aid that along. It could aid that along. But I guess I want to come back to the main thing, which is, though, simply this. We see, the committee, as you can see from the SEP, the committee is completely unified in the need to get inflation down to 2%, and will do whatever it takes to get it down to 2% over time. That is our plan. And you know, we understand that allowing inflation to get entrenched in the U.S. economy is the thing that we cannot allow to happen for the benefit of today's workers and families and businesses, but also for the future. Getting price stability back and restored will benefit generations of people as long as it's sustained, and it really is the bedrock of the economy, and you should understand that that is our top priority.
Just a quick follow-up on that. I'm just a little confused because you said the committee will do whatever it takes to get inflation down over time. But when I look at the SEP, inflation is still projected to be
They could get
elevated
inflation
next year,
down in a
but the Fed
heartbeat if
funds
they
rate
tell the
is lower
politicians to
than
stop
where it is
spending money
now.
they
Can you
don't
help me
have.
understand that?
Sure. So you know, if you look 2 and 3 years out with the forecast, first of all, I wouldn't put too much weight on forecasts even 1 year out.
They could
because
kill this
they're
inflation
so
problem
highly uncertain.
just
But
like that.
What they're showing is that
What a
as
load
inflation
of
comes
horse
down
crap.
in the forecast, if you don't lower interest rates, then real rates are actually going up, right? So just to maintain the
Klaus's
real
great
rate,
reset
the
in
nominal
technical
rate at that
color
point,
here,
2
folks.
years out, let's say, should come down just to maintain real rates. And actually, you know, since we're probably going to, we're having real rates that are going to have to be meaningfully positive and significantly so for us to get inflation down, that probably means that certainly means that it will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, we're talking about a couple years out. I think, as anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate if you think about it. Inflation has not really moved down. It is not so far reacted much to our existing rate hikes, and so we're going to have to keep at it.
Julie. The mic is coming.
Oh, sorry. Thank you. Hi, Chaparral. Julie Chabanas, AFP News Agency.
She
the
wants
May
his
job
baby.
report showed a rebound in May in black workers' unemployment. Is it consistent with the Fed's maximum employment mandate? Are you worried about that, about this rebound?
So we are, of course, worried about.
She
there
sounds
are longstanding
socialist, too.
differences in racial and ethnic groups across our labor market. That's a factor that we can't really address with our tools, but we do consider that when we're thinking about what constitutes maximum employment. It is for us a broad and inclusive goal. And so we do watch that. But remember, all unemployment, including black unemployment, has been bouncing around right near historic lows, historic modern lows here. So we're still talking about, I mean, what is as strong a labor market as we've seen in, you know, a half century here in the United States. So overall unemployment of 3.7% is 0.3 higher than it was measured to be at the last a month ago, but still it's extraordinarily low. And so it's a very, very tight labor market.
Megan.
Thank you. I want to follow up first a little bit just on the rent question on housing. We heard Governor Waller talk about how, I'll back up, we haven't quite seen the slowdown in rents show up in CPI yet, and we did hear Governor Waller talk about how an uptick in housing might mean that there's not going to be as much relief coming or a shorter bit of relief than we thought. Can you talk about how you're thinking about that and how that played into today's?
And I don't want your baby.
I wouldn't say, so that's, you know, as a factual matter, that's correct. We do need to see, you know, rents bottom out here or at least stay quite low in terms of their increases, because we want the, you know, we want inflation to come down, and rental is a very large part of the CPI, about a third, and it's about half of that for the PCE. So it's important, and so it's something that we're watching very carefully. It's part of the overall picture. I wouldn't say it's the decisive part, but take a step back. What you see is look at core inflation over the past 6 months, year. You're just not seeing a lot of progress, not the kind of progress we want to see, and it's hard to avoid that. And you know, the committee, people in the committee, the median went up significantly, so that the median participant now thinks that core PCE inflation on a 12-month basis will be 3.9% this year. So once again, every year for the past 3 years, it's gone up over the course of the year, and that's doing that again. So we see that, and we see that inflation forecasts are coming in low again, and we see that tells us that we need to do more. And so that's why you see the SEP with where it is.
Could you also talk briefly about your outlook for wages?
How about tell these governments to stop spending money they don't have?
Housing, how far you think wages might need to fall in order to get inflation back in line?
So wages will continue to increase. So we you know, what we're talking about is having wage increases still at a very strong level, but at a level that's consistent with 2% inflation over time.
Interesting pivot coming in here. You can see the U.S. dollar's trying to bottom and the euro's trying to top here.
Measures of wages have
Notice how
moved down
Bitcoin's
from
also
extremely
topping and
elevated, but
Ethereum's
highly
nowhere
elevated
near the old
levels
high.
a year or so ago, and they're
Something's
moving back
happening
down,
here.
but quite gradually. And you know, we would want to see that process continue gradually. Of course, it's great to see wage increases, particularly for people at the lower end of the income spectrum. But we want that as part of the process of getting inflation back down to 2%, which benefits everyone. I mean, inflation hurts those same people more than anyone else. People on a fixed income are hurt the worst and the fastest by high inflation.
Greg.
Thank you so much, Chair Powell. Greg Robb from MarketWatch.
Greg wants his baby.
I just wondered if the committee has talked at all about the labor market, and there's strikes now in Hollywood, and now the United Auto Workers are talking about a possible strike. I mean, aren't workers, we have some, workers have power now and are going to be seeking higher wages. Does that come up in your discussions? Thanks.
So the topic of wages
He
in the
seems a
labor
bit old
market
nowadays.
and dynamics in the labor market is about as central a topic to our discussions as anything. I mean, it's very, labor economics, you know, and the labor market are utterly central. You know, it's half of our mandate. So we spend a lot of time talking about that. I think, you know, there are structural issues that are really not for the Fed, and so we don't spend a lot of time, although we take notice of what's going on, but we're not, you know, we're not involved in discussions or debates over strikes and things like that. But we, you know, we look and we see what's going on, and, you know, we're making judgments about what it will take to get inflation down to 2% in the aggregate. And as I said, don't think that was about, most folks would say now, it wasn't really about that, about wages.
Oh yeah, what happened there? Sorry.
And it's becoming more about that as we get into really service sector inflation, which is the part of the economy where we have seen the
I'm
least
getting emotionally
progress.
triggered, so all the cracks falling apart here.
Thank you, Mr. Chairman. Mark Hamrick with Bankrate. Wondering what your thoughts are now about systemic risk now that we're about 3 months past the failure of Silicon Valley Bank, and also specifically, what are the risks associated with commercial real estate as well as non-bank financials, and could you further elevate those risks with higher still rates, possibly for longer?
So, we're trying to think where to start. I'll start with commercial real estate. We, of course, we're watching that situation very carefully. There's a substantial amount of commercial real estate in the banking system. A large part of it is in smaller banks. It's well distributed. To the extent it's well distributed, then the system could take losses. We do expect that there'll be losses, but there'll be banks that have concentrations, and those banks will experience larger losses. So we're well aware of that. We're monitoring it carefully. You know, it feels like something that will be around for some time, as opposed to you know, something that will suddenly hit and you know, work its way into systemic risk. In terms of non-bank financial sector, there's been a ton of work, and you know, clearly in the pandemic, it really was it was the non-bank financial sector where issues really arose, and you know, there's a lot of work going on with the administration.
Wow, crypto coming on
in
hard
particular,
here.
leading that to try to address issues in the Treasury market and in all kinds of areas in the non-bank financial market. But you know, our jurisdiction at the Fed is over banks, actually bank holding companies and some banks. So that's really our main focus. You know, in terms of the events of March, as I mentioned earlier, we will be carefully monitoring that situation. You know, our job generally involves worrying about a lot of things that may go wrong, and that would include the banks. It might be hard for me to identify something that we don't worry about rather than that we do worry about. So we're watching those things very carefully. And as we see things unfold, as we see what's happening with credit conditions and also all the individual banks that are out there, you know, we'll be able to take, to the extent it's appropriate, we can take, if there are macroeconomic implications, we can take that into account in our rate setting. And so I guess that's what I would say.
Can I just follow up on the last part? That's, do you risk further exacerbating those issues if you get up to another 50 basis points?
So that's, and I guess I meant to address that by saying, as we watch, we'll see what's happening, and if we're seeing the kind of tightening of conditions that you could be referring to, then we can factor that, because really we use our rate tool it really has macroeconomic purposes, so we'll take that into account. Of course, we have responsibility for financial stability as well, and that also is a factor that we're always going to be considering. Thank you very much.
Well, there you have it, folks. Happy Hanukkah. Don't know whether you got what you were hoping for out of that. I suppose we could do a quick summary of what's happened here in reaction to Mr. Powell's testimony here, or I guess, what do you call it? Press conference? What are some big takeaways? Interesting how the knee-jerk reaction right out of the gate was a big rally in the US dollar and big dumping and things like the corn and the currencies. So right out of the gate, this was almost kind of like a sell the rumor and then instantly on the news release, buy the news. It's interesting, actually, somebody at TRI posted in the lounge here that usually the market performs following the FOMC event. We sell off. Now, of course, we've been talking lots about this recently, so this shouldn't come as any shock to anybody whatsoever. But I get the impression it was another one of these sort of buy the rumor, sell the news of it. So that doesn't really surprise me too much. It's interesting to see sort of halfway through the testimony, Bitcoin and Ethereum started to actually bottom, and Ethereum took off first. I don't know whether you guys noticed that. And actually, it looked like, to be perfectly honest, it looked like Bitcoin and Ethereum, crypto in particular, were actually leading the broader market, because you notice that down in here, just as Ethereum was starting to bottom and Bitcoin was starting to bottom, you can see the stock indexes, they were kind of like, well, maybe, I don't know. Then all of a sudden, the crypto market took off like a rocket, and that just surged all the stocks. They all started to move up in earnest. So that jumped out at me. Also, too, I think a big thing that jumped out at me was, you notice how he acted. They could solve this whole inflation problem like that if they just simply told the governments, and it's the same thing in my country. It is so bloody frustrating. These, maybe somebody at that press conference should have said, Mr. Powell, since nobody wants to have your baby, we're not going to call you Chair Powell anymore. Have you ever heard of a gentleman called Milton Friedman? I don't know whether that gentleman's familiar to you at all. And the irony of all of this is, if these damn governments would just stop with this damn deficit spending, and more importantly, the growth of the deficits, you heard them saying $2 trillion. First off, who here can actually imagine what $2 trillion even looks like? I mean, it's such a staggering number. None of us can wrap our heads around this anyway. And, his unequivocal response was, no, we're not going to touch it. And then they came back and said, okay, well, are you going to help finance some of these deficits? And he said, absolutely not. So, I mean, the sad thing is they're setting us up. They know exactly what's going to happen here. And I hate to say it, folks, but maybe I better show you this image again. The only question is, where the hell do I have this thing saved? I guess probably the easiest way to do it is just Google, because I put my bookmarks away. Yeah, let's see, maybe I can pull that back up. Hold on. You can see what's going to happen here. I mean, it just pisses you off, because, I mean, this is so obvious. The only problem is I don't know where the hell I put the damn link. These are all charts. Yeah, I'm gonna have to just Google it. 1940s inflation. So I've shown you guys these charts repeatedly in the past. The only problem is I don't know whether well, anyway, just a simple chart. here is what I unfortunately I think has to happen before we get through this is, we just went through that initial inflationary burst. And unfortunately, this is the really bad part that still has to come. Mind you, this is not the data I wanted to show you. Actually, it's interesting how they've kind of fudged this because that's awfully low. Anyway, longtime site members know exactly what I'm talking about. The annual inflation rate. Maybe it was a annual inflation. Did I actually have that in there? No, something different. Darn. Anyway, in the latter part of the 1940s, which is what I think we're basically going through now, the inflation went up much higher than what we're going through right now. So you can already see that they basically said that, well, we're going to hit some sort of wall and this spending is just not sustainable. But we're not going to say anything to the actual politicians to try and stop this until, and actually there was somebody there on YouTube who said this perfectly. I thought it was a pretty good statement. Where was it? Anyway, somebody over on YouTube said something along the lines of, oh yeah, there it is. They'll finance the deficits and the debts if revocation of the corporate federal charter is at stake. So it's just that simple. They will only come to the rescue because keep in mind, the only reason why they did quantitative easing and all that bullshit was because basically the banking industry was bankrupt and about to tip over. So if all hell breaks loose, then they'll come back to the rescue, which of course injects a whole bunch of inflationary pressures, spending, printing, all that kind of talk. And they'll only do that if the whole damn thing's about to fall apart. And actually disappointing, I can't find that darn, maybe I have it. It's weird, I have so many links. Darn. Of course, when I look through these things after the fact, I'm always, no, I can't find it. Damn it. Of course, when I want to show you these things, I never can find them. Actually, you know where I might have them? Hold on. I'll screw it. Doesn't matter. Okay, so recap, and we'll wind this up because actually Zach's got to get this video feed ready for class. But the summary, as I had said earlier, was a knee-jerk reaction was sort of buy the rumor, sell the news. And of course, US dollar exact opposite. So think of basically the US dollar when it goes up, risk assets go down. You can see how all the stock markets came off, Bitcoin, crypto came off. As he was chit-chatting away, I think they kind of calmed down a little bit. The one thing that actually jumped out at me that was a bit of a surprise was to see the violent rally in the euro dollar market. That's sort of the smatterings, if you will, that maybe this interest rate cycle is nearing an end, right? And we've been talking about how the interest rate cycle should be coming to an end here pretty soon. And over the next probably 6-12 months, we start to hear them talk about not only peak in rates. I also think too that they won't start cutting rates until they actually see something break in the economy. I personally think it's going to come from overseas before it comes from within the United States. And that's just my personal opinion. At the same time too, we should probably keep an eye on some of these high flyers. We've talked about the debt issuance issue coming up here shortly. Stocks like Toyota, can it actually maintain that kind of pace of price appreciation? I don't think so. There's Brian, of course, bidding at the bottom end of the range and just being left behind like a schmuck. Drive you crazy. But oh well, that's the way it goes. Sometimes you get them, sometimes you miss them. Actually, interestingly enough, this one just went and put in a weekly double bottom. And they're actually going to go in and start picking up the assets from the companies that are going bankrupt. So Overstock in particular is going to go grab all of the Bed Bath and Beyond assets, all their goodwill and all their monetary assets that would just normally get disposed of in receivership. So interesting how we got big bottoms coming in on that part of the market. The alternative fuel part of the market looks very, very sexy. I don't see how this stuff stops. I mean, look at that, right? So there's the effect of your short-term interest rates being cranked up. Is this market trying to tell us that maybe, softs or bottoms, the lows are much shallower? In fact, actually now we're starting to make higher lows. I get the impression that's the case, So, and then of course, market leaders. This was an interesting one that we had a bull call spread that probably should come into like double levels. Interesting how we've hit Foggenbaums. We talked earlier about how the market is going parabolic up into this Fed event. And now the question is, does the US Treasury come out and just flood the market with treasuries? Considering we just hit the 2.618, we're coming up into old historical pivots. Looking for a bit of a pause here isn't an outlandish idea. And then the semiconductors as another good example of sort of resurgent demand. This looks extremely strong. Another order that I had working right down at this gap, and it just missed me by a hair, pissed me off. But look at what that damn thing's doing now. And I personally think that this thing's probably going to be right back up top in the not too distant future. You can see the huge gaps up top. So that one kind of pissed me off. So you can see there's a lot of anecdotal evidence. Like that's not a bear market. That's not what bear markets look like. My hunch is that the Fed's going to be slowing down its rate increases, and it will only actually lower interest rates when actually something breaks. But you can feel there are parts of the market, of course, Sjord TRIs, our CTO. He is intimately involved in a lot of the crypto space with regard to AI and the video rendering and stuff. That's sort of the same kind of conversation. It's slightly different, but the semiconductors, these kind of stocks. I mean, look at that big damn W. That's a bullish chart. That is not a bearish chart, right? Not sadly, the public comes in and buys these things when they get bid up, but when they look like this, public's nowhere to be found. So, you put it all together, I think the economy is doing relatively well, and it will probably continue to do well until something actually breaks. I suppose a lot of people have been conjecturing, is it Bitcoin that breaks? And I've made the argument that Bitcoin was a store of value story through that fear cycle, and it did its job admirably. Has maybe Bitcoin and Ethereum and stuff like that maybe gone a little too far too fast, and they maybe need to clean up, because keep in mind, Bitcoin price has already doubled here from the bottom. I don't necessarily think that Bitcoin is a good short here. The way that I'm looking at it, I mean, like if you trade setups, that's another conversation. But for like investors, if you could get a dip in Bitcoin back down against these lows, reload zones, all that kind of fun stuff, I think it's a fantastic buying opportunity. Okay, so that's basically what we're seeing in the market. I think probably the chart I'm going to be following closely here through the options expiry to sort of get a feel for whether June, July peak in the market is done, is this futures chart. All the pieces are in place for this thing. We have trade location. We have indicator confirmation now. Markets are going into divergence. Divergence hasn't been confirmed yet here. Willie is stupidly overbought. So really, I might argue any kind of weakness here, there is the options expiry event. My hunch is probably going to do something like this. And then any kind of M top, if this creates a divergence in the momentum indicators, any kind of M top here will be a fantastic short. But right now, it's just not there yet. There is no top just yet. So slow and steady wins a race. PMA for the win, all the best. And I better stop talking. So have yourselves a fantastic rest of your day. Oh, and by the way, we're not going to be doing Coinigy show tonight. The Coinigy people are away, so we'll try and do one maybe next week. But I think I'm going on vacation next week, so it'll be a couple weeks before we do another one of those Coinigy shows midweeks. All right, have yourselves a great day. All the best, and bye for now.